This was not the most regulated portion of the economy. That's why I went through the story of the mortgage bankers who were unregulated and did 80% of the non-prime lending. It was the least regulated sector that did the dominant amount of the harm in this case. And I really, in a group valuing traditional values, urge you that accountability is one of those. And so the idea that, well, the private wrongs were secondary, and so we'll talk about them for, I think, 3.5 seconds in a presentation is inappropriate. The FBI says it is irresponsible to discuss this crisis without discussing the role of fraud, and that 80% of the losses come when lender personnel are involved in the mortgage fraud. Markets are not constantly correcting. This has empirically been disproven in this crisis. The bubble kept on expanding. A bubble expanding is the opposite of a market self-correcting. Spreads went completely in the wrong direction, right? The spreads should have been widening. Spread is the difference on the interest rate on the non-prime loans versus any other index virtually, but let's take it, government treasuries. So the FBI begins warning in September 2004 publicly that there's an epidemic of mortgage fraud. Everybody knows that underwriting standards are going to hell in a handbasket. And most people have figured out there's a housing bubble. It is unambiguous that the spread should widen dramatically in those circumstances. In fact, it went in the opposite direction. Mark, there is no way you could have pick-a-pay mortgages without the FDIC. Well, we had pick-a-pay mortgages being common among institutions not insured by the FDIC. So that's empirically not the case. I don't have time, but ask us about Freddie and Fannie. In the interest of brevity, I'll move on.
I'd be interested in the fact, but I don't think anybody could portfolio pick-a-payment mortgages without the FDIC. It'd be interesting who the facts are. But I'll tell you the story on the savings loan industry. BB&T acquired more savings and loans than anybody during the financial crisis, and got to see it from the inside. It's an interesting history about the long-term implications of government policy. The problems of the savings and loan industry, interestingly enough, started with Lyndon Baines Johnson. And it started in the 60s. Johnson wanted to have the war on poverty, the Great Society, and he also wanted to have the Vietnam War. But he didn't want to tax people because that's not good politics, right? So he increased spending dramatically, and the Federal Reserve accommodated that. I was there when this was going on. They printed a bunch of money. Of course, that led to a lot of inflation, right? Interesting problem for the savings and loans. Savings and loans had been in business. My primary driver of residential finance in the U.S. was savings and loan industry. Some of you are my age, and when I got my first home mortgage, I went over to local savings and loan. You put 20% down, you got an 80% loan over 30 years. They'd been in that business for 60 years and had very little credit losses. But they were making fixed rate mortgages, and when Johnson created inflation, the Fed financed it, then they had to be corrected. Interest rates were very high. Prime rate went to 21%. They got negative spreads. Lots of savings and loans failed. Then they got help from the regulator, the FSLIC, which is now the FDIC. And the regulator gave them some interesting advice. First, it told them to hedge their mortgage portfolios. The problem with hedging home mortgages, there's no prepayment penalty. So they got killed when rates started falling. Secondly, they were very strongly encouraged to get in the commercial real estate lending business to finance shopping centers and office buildings, et cetera, which they had no expertise in. In 1990, most of the remaining savings and loans failed. The few that survived, interestingly enough, had an interesting challenge. The gap, that's how Freddie and Fannie became such big drivers in the residential construction business. They took over the prime mortgage business. People like us were in that business. We could have filled in the gap with savings and loan, but you can't compete against the federal government. Leveraged 1,000 to 1 with a government guarantee. We were driven out of the prime mortgage business but by Freddie Mac and Fannie Mae in that regard. You know why Golden West got in the negative amortization pick-a-payment mortgage business, which they financed with CDs? Because they couldn't compete in the prime rate business. They had to have something they could do. Freddie and Fannie then created the broker model. Now, a lot of people tagged on lots of these mortgage brokers, which were really peripheral players in the marketplace, because they were all feeding Countrywide and Washington Mutual, feeding Freddie Mac, feeding the capital markets. We were taking some of their production, although we never did the subprime the subprime business, but they were the marginal players in the marketplace. And Freddie and Fannie were created as the savings and loan industry was systematically destroyed. So combination of Federal Reserve policy and the action by the federal regulators set up the whole, it's a long-term process. And that's, you really have to look at these things in the context. And it's, when you're inside the animal, you can see what's actually happening, see how people's behaviors are driven.
Yeah. The one point John's making that I would pick up on, I actually think increased capital ratios and
Use the next mic.
I think it's just me. Increased capital ratios and equity financing is the heart and soul of the solution. And if financial institutions were 25 to 50% equity, the owners over time would sort of discipline them, and good owners would get richer, and bad owners would go out of business. I think deposit insurance is sort of separate in that I think it's naive to think that counterparties, you know, sort of people who are using financial institutions sort of peripherally to other transactions. For them to be the policing agent is naive. I think what would be apt to happen in that kind of situation is people take out institutional risk by diversifying across 20 or 30 institutions. They won't know anything about them, so they'll still be prone to rumor and so forth. When you know, one of them becomes rumor, all right, you pull your money from that institution. And if you become scared sort of systematically, you pull your money from all of them and place it in the mattress, which is you know, to a degree what happened in the fall. So I think equitization is a great idea and has to happen, but there probably should be a system of reliable that takes the burden off people that aren't in position to evaluate it and isn't the highest and best use of their time. That should not be the primary disciplining who holds the disciplining role in the financial system.
Okay, we have time for questions. To ask a question, you need to go to one of the two microphones that are in the back, and you can ask your question of any of the specific panelists or just generally. The main rule in questions is that they have to be questions, because if we had wanted a speech from you, we would have put you on the panel. So please don't make a speech, but ask a legitimate question, and I'm sure these panelists will be more than eager to engage you in a conversation. Okay, so we'll start.